Budget 2026 has pointed out an interesting investment option for you, municipal bonds. But here is the catch. If you walk into your bank today and ask for a Chennai municipal bond, you might get a blank stare. That is because while municipal bond issues do happen, they are mostly issued through private placements, essentially sold to big institutions with very little information available to the common man. So, how does a common investor get a seat at this private table? Today, we show you how you can break into this club and invest directly in your city's growth. Hi, this is Abhirami Sekar for TheFederal. First things first, what are municipal bonds? These are bonds issued by urban local bodies to raise money from the capital markets for city development. The aim is to increase transparency, bring more money into urban development, reduce dependence on central grants, and allow people to invest directly in their city infrastructure. As the name suggests, these are debt instruments. You lend money to your city admin, which uses it for city infra and returns the money with interest. But these bonds don't just lie in your portfolio, they are traded on stock exchanges and work to increase your wealth. Budget 2026 made it attractive for cities to go for these public issues by offering a rupees 100 crore incentive for single bond issuances exceeding rupees 1000 crore. This falls under the Amrut scheme. If you wish to invest in these, understand that it's about more than just civic pride. It's about making your money work harder than it does in traditional savings. Bank FDs are considered safe. So why move money from an FD to a bond?
First of all, it's important to know that no investment is completely safe. Even a fixed deposit investment carries some risk. Similarly, whether it's a municipal bond, whether it's a government bond, there's always some element of risk. It could even be from a liquidity perspective of the ability to sell. I think in general, municipal corporation bonds have given a fairly good performance, fairly safe performance, on account of the fact that they are largely issued by quasi-government institutions. There is a certain inherent feeling of safety in these products. But I would advise investors to look at which respective municipal corporation they are investing in, what are the financials of it, what has been the past track record, and keep into account factors like the tenure of the bond before investing.
In India, there are two ways bonds are issued, public and private placement. Public placement is like a movie release where everyone can buy a ticket directly, but this is rare for municipal bonds. Most cities use private placements, meaning they sell the entire bond to big banks or insurance companies at one go. Once those big banks buy the bonds, they sell them on the stock exchange or through specialized bond platforms. This is the secondary market, and this is where you, the retail investor, come in. Let's hear from an expert. Can a regular person join this private club?
In India, bond issuances generally are placed through private placement route. Almost 90% of the bond issuances are placed through private placement route. Very few bond issuances are happening through public placement route. However, the SEBI, the regulator, are encouraging the issuers to tap the market through public issue so that the retail investors can directly participate in the bond issue. So, as far as the municipalities are concerned, very few municipalities have tapped the market through public placement like Indore. Wherein the private retail investors are able to directly participate in the municipal bond issuances. Going forward, as per the new regulations in the budget, the minimum bond issue size, they're going to keep it at 1000 crores, wherein the incentive is given 100 crores. There we expect all the municipalities will try and tap the public issue route.
Before you buy a municipal bond, you must understand three numbers: credit rating, maturity, coupon versus yield. Let me break down this for you. Think of the bond as a student. The credit rating is the report card. It tells you if the city is an A grader that always repays its debts. The maturity is simply the timer. It's the exact date your original money comes back to you, just like FDs. Now, don't get confused between coupon and yield. Coupon is the fixed interest the bond promises to pay you every year, just like FD interest. If a bond of 1000 rupees has a 8% coupon, you will get 80 rupees a year no matter what happens to the bond's market price. Coupon rate never changes once the bond is issued. It is printed on the bond. Yield is the actual return you earn based on the price you pay for the bond today. Remember, your bond is also traded in the stock exchanges, so its price could go up and down. If you buy that bond at 1000 rupees, your yield is 8%. But if you buy it cheaper, say at 900 rupees, you are still getting 80 rupees a year. So, your return is higher. If you buy it at 1100 rupees again, you get 80 rupees but the yield is lower. Yield moves up and down because bond prices move. An easy way to remember it, coupon is what the bond pays as a routine. Yield is what you earn depending on how the bond performs. That's why in markets, people track coupon. It tells you whether a bond is cheap or expensive today. Are these returns really tax free?
Interest may not be tax free. There are certain tax free bonds which are separately classified when they're at the time of issuance. These tend to be either bonds issued by the government of India or certain infrastructure PSUs. But all bonds issued by governments or municipal corporations are not inherently tax free. So an investor must keep that in mind before investing and look at the offer document before investing. A tax-free bond will typically have a lower return than a taxable bond. And that distinction needs to be understood before making an investment. Do not assume that it is a tax-free bond just because it is issued by the government or municipal corporation.
Whether it's a private or public issue, the safety mechanism is the same. The city body has an escrow account, which is a secure, temporary and neutral third-party account used to hold funds, assets or documents during a transaction. They ring fence your money and make sure they are not easily siphoned off. Have doubts like, is your money safe if a project is delayed? Where in India is this working successfully? Let's see what experts say on this.
They get paid on time because, generally what has happened is a repayment schedule is not linked to the project. The repayment schedule is decided as per your own revenue income, which is your tax revenue or fees and user charge. So, even if the project gets delayed, which is a general phenomena if you look at all government projects across the country, government funded projects generally tend to get delayed. So, that is why it is not linked to project revenues or commissioning of projects. It is always linked with your own existing revenue stream, so that your principal and repayment both are done on time, because these revenues come regularly. Project revenue may get delayed. See, for example, if we look at Tamil Nadu itself, as on date, Tamil Nadu has done 4 municipal bond issues: Chennai, Coimbatore, Tirupur, and Trichy. And investors are getting good rates. Corporations are also getting lower rates than what market expected, their normal expectations. So it's a win-win situation for both of them.
These bonds are mostly placed privately. So, how do you actually buy one today? Here is the process. The retail path. First, the discovery. Use a SEBI regulated online bond platform or ask your stockbroker. Second, the search. Look for municipal or sovereign category. Third, the check. Check out the face value. Some private bonds have a high entry price. Example 1 lakh rupees or 10 lakh rupees, but many are now available for 10,000 rupees. Fourth, the purchase. Use UPI or net banking. The bond shows up in your demat account. The budget has made a push for cities to go big. Even if these bonds start as private placements for big banks, they eventually flow to the secondary market where you can buy them. It's a chance to earn more than an FD and see your money build the roads you drive on. Do your research, check the ratings and start investing wisely.